The economy appears to be strong, and even though we do get these headlines about job layoffs, unemployment generally remains low. Expectations have pushed off a Fed rate cut until May, June. But bank stocks are really under pressure here. Some industry watchers say there are real risks ahead. Joining us to discuss this, Ebrahim Poonawala, the head of North American Banks Research at Bank of America Securities. Ebrahim, good to see you today. Where do you see risks, especially for the banks? Banks like we just heard from Leslie, Morgan Stanley.
So thanks for having me on. And when we think about just the broader bank sector you referenced earlier, let's just be clear, right? A stronger U.S. economy is generally good for bank earnings, bank stocks over the medium to long term. The risk that we really see is if we get into a period where inflation turns out to be sticky, the Fed has to, instead of cut rates at some point this year, actually stay higher for longer or potentially hike interest rates. All of those could lead to probably potential worse outcomes for the macroeconomy and maybe lead to a hard landing. So that's the risk. It's a tail risk event, but it's not off the table, and that's something that you're watching for as markets recalibrate outlook for interest rates in the real time.
If that happens, what would be the specific consequences for banks? Are you looking at default, tightening credit situation? Give me a sense of what the specific consequences are.
Sure. So I think the specific consequences would be if we do get into hard landing, essentially if you get into a recession, you could see defaults across consumer, commercial pick up. That leads to higher than expected credit losses. So you essentially see your old-fashioned credit cycle on the back of an economic recession, which wasn't quite the base case for us or for the markets, I think, coming into this year.
Let's talk a little bit about one of the things I note, and that is that you say the market has treated stronger economic data as a negative for bank stocks. Why is that, in that a bank would generally benefit, wouldn't it, if credit, if defaults and delinquencies declined in a stronger economy? I would think a bad economy would show up in their loan book.
So you're right, and it's ironical, right? I've grown up thinking about banks are a reflection of the economy they operate in. And I think what we're dealing with right now is there are two aspects to this. One, given the speed at which the Fed moved from 0 to 5%, initiated QT, there's a bit of a repricing lag between what we are seeing in terms of funding costs today. And over time, some of the fixed rated assets on bank balance sheet that will reprice and get kind of reflect where the market interest rates are. So it's a bit of a timing issue, which creates a bit of a squeeze on net interest margins and revenue growth for the banks today. And secondarily, I think there is a narrative, as we've seen over the last few weeks, around higher rates leading to concerns around commercial real estate sector and the repricing risk. And I say the narrative because fundamentally, if you talk to experts, and we've spent a lot of time talking to internal R teams and external experts, the CRE issues today are very acute in the CRE office space. But when you look through any other subsector across CRE, the issues are a little bit less pronounced. And actually, most of these subsectors are doing quite well.
I don't know whether you cover Morgan Stanley, but we just had that report from Leslie Picker about layoffs in their wealth management group, which I thought, and I think Wall Street believes, is the kryptonite in Morgan Stanley's portfolio. Wealth management has been their strength, recurring fee income. They're not, which means that they're less prone to swings in trading revenue or investment banking and so on and so forth. What is your reaction there? I don't know whether you cover Morgan Stanley, but to layoffs in a bulwark part of Morgan Stanley Wealth Management.
No, absolutely. We cover Morgan Stanley, and actually we'll be hosting their head of wealth management, Jed Finn, at BofA's 32nd Financials Conference next week in Florida. So we're looking forward to that discussion. In terms of the layoffs your colleague announced, it's a few hundred on a base of 80,000 employees, give or take, at Morgan Stanley. So I don't think you're right. It is the crown jewel business. There's a lot of focus in terms of how the margins in that business evolve over the coming months and quarters. It is fiercely competitive, but I wouldn't read into too much in terms of the few hundred layoffs on an 80,000 employee base as it pertains to their focus in that business. Yeah.
Sounds reasonable to me.